Hello everyone. Welcome to the weekly Q&A on 7/5 of 2023. We are going to cover a couple questions about the real estate market, about homes. Do we want to buy them? Things like that. Those are just some questions that kind of popped in, and so we'll cover that. Also, I'm going to kind of overflow a little bit of our Sleepwell portfolio monthly meeting because it ended up backing up into this time just because of the holiday. So, we're kind of just pushing everything together a little bit. So I'm going to knock that out too. So we just left off talking about bond yields and how they're going to be affected. So let me just go ahead and kind of share that screen, and then we'll just talk about that really quickly over here. All right, so back here on this, let me just kind of collapse this down so we can kind of see things. So back here, we've got basically TNX. It's an ETF that follows the yield of the 10-year treasury. And we were talking about, why has it been rising lately? What's been going on? What drives these types of things? What definitely drives this, no matter what, is inflation acceleration, right? So let me just kind of throw up inflation up here, and this will start to kind of make a little bit more sense. So back here in orange is inflation and like year over year inflation. And as we kind of push back in time, you're going to see that there's some kind of correlation behind this, right? Like, whoa. Yeah. So as inflation accelerates, so too does the back end of the bond yields, right? And then, it's not a perfect one for one, right? Sometimes you get inflation stabilizing and dropping, and yields have actually been dropping previous to it, right? So, but you can see here, predominantly, you almost look like you're looking at the same thing. As inflation accelerates back here, right? So here's a big acceleration. Let me grab a pen. So as you get a big acceleration in inflation, you get an acceleration, or you get a rise in the yield curve back here. Okay, here's another push higher in inflation, a push higher in yield curves, right? Then you get a push lower, push lower, push lower, push lower, right? It's all the same story, right? Okay, so now you've got the COVID thing, right? And when you go into the whole COVID thing, right, you get this big pop of acceleration in inflation. And that's because we printed a lot of money, we monetized a bunch of debt, we sent checks out to everyone, and we were spurring the economy to basically shut down. And we basically printed our way through that. And that's a challenge. Anyways, you can see as the interest rates actually confirmed rolling over right about here, right? You finally started to roll over. Not necessarily saying the peak, but right around then, you had the 10-year bond, the 10-year yield start to roll over and come down. Now, what's going on here? Why do we have this push down, but yet we have a rise in yields back here? One possibility is that we're going to get another spike in inflation. I doubt that that is going to happen over the next 3 quarters, with us projecting that we're going to get contracting GDP over the next 3 quarters. So we're basically getting a depression. It's going to be really hard to have an inflation spike through that unless the government starts printing money and handing it to people. I don't know if that's going to happen, but if it does, then the bond market knows something I don't, which is very possible. But that's one explanation. The other explanation is that the demand for US debt is not quite as high as it used to be unless we actually have a recession. There's a lot of debt trying to be financed right now for a lot of spending that's going to happen over a certain amount of time. I'm not going to get into the politics because I'm not a politics guy. But basically, the economics behind it is that people have to buy the amount of debt that the U.S. government is putting out there. As the U.S. dollar becomes less dominant, there's less of an incentive to hold U.S. denominated debt, U.S. denominated currencies, and therefore there's not as much growing demand for it, right? And so that can actually make yields spike even if inflation on a CPI basis is actually cooling off. So that can detach the two, this relationship, right? It can detach inflation from the yields. And that is probably likely what we've been seeing for a little while now. We've definitely been seeing back here in the background that yields are not dropping as aggressive or as hard as the inflation is basically dropping. So it is what it is, but at the same time, they also did not spike as aggressively as how big our inflation is, right? We, for how much inflation was back here versus how much it rose, yields were here. Yields should have gone way to the moon, right, to equal the amount of inflation spike that we had. We didn't get that much. So therefore, we might not get that much on the way down. So that's also another reason that we might not be getting that kind of rollover. Either way, this is probably going to be a relatively good asset over the next 3 quarters. That doesn't mean that it's going to be a great asset. I talked about this in the Sleep Well portfolio monthly meeting and the Awake monthly meeting, that we will probably prefer some other assets. That's a whole different part of that service and holding that portfolio and seeing those assets. But there you go. So bonds probably will not likely be the best asset to hold. In fact, yeah, there might be some other ones that would be kind of counterintuitive. All right, so from here, we are going to talk about one of my favorite just indexes about home affordability and kind of what things are going to happen as far as that is concerned. So I'm totally moving on to another topic, but let me make sure that you guys hadn't thrown in anything that you guys wanted to talk about. Okay, so right now we're doing good. If you guys want to say anything or something like that, throw it in the chat, by the way, and I'll answer it along the way the best I can, and I'll even veer off topics and things like that. All right. So as far as the home is concerned, literally the home, oh, not this one. Dang it. Let me grab the right one. Aha, here we go. So as far as the home is concerned, literally HOAM index, this is like a home affordability monitor. This actually comes out from the Federal Reserve Bank of Atlanta. So this data that we're looking at here compiles a few different variables. And the variables that we see down here are basically the amount of income change that we see for people, people, home buyers, right? The population, the interest rate change, and the price change, right? That's down here in the drivers of affordability. That doesn't necessarily mean that it makes something affordable. What it actually makes it is it just shows us where are things going. Are they becoming more affordable or less affordable? The absolute number of basically how much does something cost, the average price, the metro, the average metro price, and then what the interest rates are, that's actually what matters. So if you see here, if you actually highlight over something, this is a freaking amazing tool, by the way. You can see that the median home price is $356,000 for a median home. The median income is $75,000. The interest rate is 6.4 right now. The median PMI or PNI, that's principal and interest, is 2,000. So the total taxes, insurance, PMI, everything is $2,572. That means that 40% of the population can afford a home. So 60% are on the sidelines. They're just not there. So, 73% is affordable. Hold on. I said that wrong. 40% is actually the how much of their income does it take to actually buy the home. So you can see going back here, right? When interest rates were basically at 2.8 and the median home price was 298 and your total share of your median income is 28%, that is actually where you can afford it, right? You can get a mortgage. Typically the mortgage company will underwrite you. Everything's really solid. Pretty much the middle class and the middle of the middle class can buy it. Now, As you reach over and you start to get into these red sections, like what happened in 2006, 2007, and in 2008, even though pricing or the home prices were actually coming down, that's what was making it affordable, and interest rates were coming down, making it more affordable also. You could see actually on the backside of here in 2000, back in 2006 and 2005, that it was basically what happened here is they dropped off a cliff, right, as the boom happened. Same thing happened in COVID. You get this big boom, except this time it's a little bit accelerated. So, when is it a good time to buy, right? Well, was the best time to buy, back in 2006 when affordability was at its lowest. A contrarian would probably say, well, yeah, because the least amount of people can actually buy it. And so therefore the prices should be at its lowest point, right? That's kind of strange that's not how the housing market actually works, right? It wasn't actually the bottom of the housing market, kind of on a broad term, really didn't bottom until 2011, right? Now we hit a couple affordable, points here in 2009, 2010, but the home market really rolled over for quite a long time until 2011. Was it overdone? Maybe. But you can see down here, in general, prices really were still dropping, right? When the blue is above the zero line, that means the prices are dropping, right? You can see they were really kind of dropping all the way until basically March of 2012. So pretty late in 2012 when it was basically pretty solidly affordable for most people. That is what drives up home prices historically, is more people being able to afford it, more people entering into the home market. Not less, but more. So right now we kind of have a locked down home market because people have low interest rates. Now, what might change is if a lot of people got assumable rate mortgages, where they start selling their home through an assumable. That is going to get kind of fancy. I'm sure at some point in time someone's going to throw that around. But basically, if you can get a home that is a relatively decent priced home with an assumable rate, basically you're going to pay what their rate was and you're going to buy them out of their mortgage. You can actually buy a home for a decent amount of money, for on a monthly basis, right? You can still find some deals out there. As those assumables become more scarce, then you get less of them. But anyways, inevitably it ends up rolling over. So from there, that is where we can kind of see where prices are going to go. We're not showing that they're going to be positive. Now, let's actually show something else, because this is kind of an interesting kind of concept. Let's look at something like unemployment. I know this is, or I should say, initial jobless claims. Maybe we'll just look at initial jobless claims. Now, if we look at initial jobless claims, let me share this. Just haven't said. All right, so yeah, here in the background we have initial jobless claims. Now, COVID is going to make this crazy spike here because we basically shut down the economy. But if we ignore COVID and we kind of go back here, we can get like kind of a more reasonable level here. And let's get this down to 1 month so that we can get more of our deal. All right, and we're going to switch this over to the SPX. All right, so now this is going to pull us all the way back. So what's good about this is we can get all the way down to 67. We can go a long time back in all these recessions. All right, so now, when did, and let's do this. We're just going to do. All right, so when did unemployment get down to like a reasonable level, right? Well, unemployment really didn't start coming down significantly until October 2010. We saw initial jobless claims actually peaked in the middle of that COVID. So, or not in the middle of COVID, in the middle of 2008. By the way, there's a reason that we like initial jobless claims. Initial jobless claims actually are really an early indicator on what type of a recession you're having, because those are layoffs. So just to kind of like zoom in for a second here, you can see that our initial jobless claims is actually spiking up. Unemployment normally lags it, right? So as you can see here, initial jobless claims spike, then unemployment spikes. It's kind of, it's a leading indicator of unemployment. So anyways, initial jobless claims, you can see start dropping. Why did initial jobless claims start dropping? That's because, less people were actually filing for unemployment. The economy started to turn around. Everything started to bottom out, literally on the screws, right? Boom. All of a sudden, that big drop started to create it. Now, unemployment, though, stays relatively high. As unemployment stays relatively high, banks are less willing to allow for mortgages. And then so you can also look at, here, let's see if we can add this in here. Net domestic, oh wait. I might not be able to find it. Banks. Oh my gosh, it is right there. Look at that. We actually were able to get it. Is that right? Yes, we were. All right. So here we go. So we're actually showing like all of the jazz right here, right? We're showing all of the economic guidance as far as on a monetary basis. So we're going to really kind of zoom into 2008, and then we can actually look into like .com too if we wanted to. But basically, purple back here is, are banks willing to lend? Okay, no, banks are not willing to lend. So then initial jobless claims and unemployment start to creep up. Why does that happen? Well, that means there's less growth in the economy, right? So there you go. Now you get less growth in the economy. That means that as less growth in the economy is happening, less people can afford to buy new homes. Well, we're basically have been at that point, right? Less people can afford to buy new homes, and home affordability is basically at its minimal. So then what stabilizes and what keeps home prices up? Well, as long as there's not a lot of people selling their home, it's not a problem, right? Because guess what? If there's not a lot of people selling their home, then there's a lack of homes out there to buy anyways. So even the few people that can buy the homes, they're scrounging for what's out there, so that can stabilize home prices. And since home prices work off of comps, that can keep prices high. Now, some prices, so like here, I live in the Seattle area, and our prices are down, I think, like 18% year over year, which is nothing compared to what they were up in, the 2020 COVID craze, right? So it's really not too much of a big deal. 18% is normally like a housing crash of epic proportions historically, but because we went up so strong, it's not such a big deal. Now, what does that end up looking like? We didn't bottom until 2012, right? When unemployment was solidly at coming down in sub 4%, right? So what happens over in this type of time frame is right now, what I've seen as far as correlation goes to home prices is unemployment and initial jobless claims actually have more of a correlation to home prices than interest rates, right? So even though interest rates went up like crazy and that dried out the home market, which that's what it does, it dries out the home market, it kills the liquidity of it, but it doesn't kill the prices of it. What kills the prices of it is unemployment, because then people have to sell their home because they can't afford their home anymore. That's when things really blow up, right? And that's when the sells actually start hitting the market, and that's what pushes things down. So our initial jobless claims are just now starting to rise. They actually started in, probably the bottom was September of 2022, and they're starting to creep up every now. We've had a quote unquote reacceleration of home prices, right, and things like that over the recent past, and that's because we've actually had a growing economy, as the last few quarters have been positive. That's not going to be the case for the next 3 quarters. Initial jobless claims should creep up here. Yeah, they're not going to be COVID. They shouldn't. I hope they're not. They shouldn't get as bad as what they were in '08. We really probably shouldn't get our jobless claims and unemployment, north of 4%, maybe 4.5%. Let's go see what the conference board is basically projecting out. So if we go look at the conference board, their projections are somewhat lined up with mine. Oh, that's interesting. So I'm at 1.3, they're at 1.2, so I was curious about that. But their fourth quarter is pretty high, a little bit higher than mine. So they're actually showing that it's going to be worse than what my models are showing. But we'll see. We'll see what actually happens. Anyways, I digress. Real GDP is going to contract in the third quarter, fourth quarter, and first quarter of 2024 if the projections end up being consumer spending dropping, right? Consumer spending drying up, right? Then what ends up coming down is we go down here and let's look at what our unemployment rate goes. 3.5, 3.6, right? And then it just starts to creep up just a little bit. 3.7, 3.9, 4.4, 4.5. 4.5, 4.4, right? So they're saying that unemployment is actually going to go up and stay up all of 2024. Whoa, that is a long standing, like stable unemployment to stay kind of high, right? And you can see that unemployment actually stays high all the way into the third quarter of 2023 or 2024 if these projections play out this way. So, just kind of keep in mind that that's kind of how it goes. You can see the Fed funds rate, right, is going to kind of compensate a little bit for that. So you've got 5.3 is what they're projected to do. They're going to raise one more or whatever. And then they're going to start dropping in the second quarter of 2024. A lot of us have already started arguing that they probably should already be dropping interest rates, but they're not. It's fine. Whatever. They do what they're going to do. But it's basically going to make the recession a little bit deeper than what they thought. So keep in mind that that's the way that we're looking and everything's going to be projected out. The, future wise, if I'm really kind of speculating here just to give us a number, because that is the question, when's the best time to buy a home? When unemployment stabilizes is going to be a much better time, right? Not necessarily chasing interest rates, because interest rates don't have a strong correlation to home price. Unemployment has a strong correlation to home price. So as unemployment drops, that typically pushes home prices higher. There are, micro economics that kind of happen in different little spaces, right? Real estate in one area is very different than another. Like over here on the West Coast, real estate is stupid. It's calming down, but it's still pretty stupid, right? Like, I think the affordability, which by the way, I'll show you this on this little tool too, right? You can go into metro affordability. Is it metro? No, it's county. So you can start typing in something here, and or we can go down. And so like I'm in Seattle, so I'll show you guys Seattle because why not? Here's Spokane, Washington. Seattle should be right up here. So here's Seattle. So you can see here in King County specifically, right? In King County, only 57%, right, roughly speaking, can afford a home here. So it's pretty sad, right? You want to go up into the affordability metrics of 100. And so, of course, Snohomish County is a lot better, but it depends on how far north you go. And then Pierce County is decent as well. Tacoma is actually kind of booming down here, stuff like that. So the whole deal is that it's still relatively unaffordable. Yes, we've improved a little inkling because the interest rates, right? So interest rates back here were 7, 6.5, 6.4, right? And you can see that the median home price has actually dropped. So median home price was 639. Now we're to 578. So that makes things more affordable as the price ends up starting to come down. So, and you can see down here, only 51%, only 51% of your annual income for the median person can actually buy the home. Now it's up to 44. We can look at San Francisco, which is actually really fun here. And San Francisco. So San Francisco is still pretty crazy. They have not been affordable for like a really long time. So, keep in mind that you have there's a phenomenon that happens in like averages, right? It's kind of like the top 1% of the 1% have like 30% of the world's wealth, right? It's so skewed to one side that it can push the averages off. So, keep that in mind. So that makes it really unaffordable here. So that, like I said, up in my metro, if we get back up into, maybe the 60s or 70s, it's probably about as good as we're going to get through this. And we'll see how it goes. But yeah, going all the way back to 2014, you can basically see that they've been unaffordable for a very long time, but the home prices have kept going up. Well, that's because, yet again, a lot of it is driven by unemployment, and we really haven't had an unemployment issue up until this COVID thing, but they were already so expensive that prices really didn't get any better. So, alrighty then, guys. I'm basically going to leave us right there with where home prices are likely headed. Like I said, unemployment creeping up, interest rates staying high, and yes, we're going to get a little bit of a drop next over the next few quarters, or at least next year, according to the some of the economic forecasts. So in general, it'll be probably middle of next year to maybe late next year will actually be the best time. All right, guys. I'll talk to you guys next week. If you guys have any questions or anything like that, email me, or you can always visit etradingedge.com for any kind of information as far as any of our option strategies or portfolio strategies or anything like that. Or you can just reach out to me at info@etradingedge.com. All right, guys. I'll see you next week.